This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. The head of the International Energy Agency said on Tuesday the G7 proposal to impose a price cap on Russian oil should include refined products as well. The group of 7 rich nations are considering imposing a price cap on Russian oil in an effort to keep oil flowing and curb inflation, while still limiting revenue to Moscow for the war on Ukraine that it calls a special military operation. My hope is that the proposal, which is important to minimize the effect on the economies around the world, gets buy-in from several countries, IEA Executive Director Fatih Birol told Reuters in an interview on the sidelines of the Sydney Energy Forum.
British lawmakers approved a 25% windfall tax on oil and gas producers in the British North Sea on Monday, which the government says will raise £5 billion, $5.95 billion, in 1 year to help people struggling with soaring energy bills. The Energy Profits Levy will target profits made from a spike in oil and gas prices as energy demand is going up after pandemic lockdowns ended and the Russia-Ukraine conflict started. The tax bill still has to pass through the upper legislative chamber known as the House of Lords to become law. The Lords can seek to amend a bill, but very rarely try to block legislation outright.
Moving on to the top news in the energy sector.
OPEC expects global oil demand to rise in 2023 but at a slower pace than 2022, the producer group said in its first forecast for next year, citing still robust economic growth and progress in containing COVID-19 in China. In a monthly report on Tuesday, the Organization of the Petroleum Exporting Countries, OPEC, said it expects demand to rise by 2.7 million barrels per day, BPD, or 2.7%, in 2023. It left this year's growth forecast unchanged at 3.36 million barrels of oil per day. Oil use has rebounded from the pandemic-induced slump in 2020 and is set to exceed 2019 levels this year. The outlook for 2023 suggests a strain on supplies could persist as growth in non-OPEC output, which has been hit by Russian losses, is expected to lag the rise in demand.
Global benchmark Brent crude tumbled to below $100 a barrel on Tuesday due to a stronger dollar, demand sapping COVID-19 curbs in top crude importer China and fears of a global economic slowdown. Brent crude futures were down by $7.62, or 7.1%, at $99.48 a barrel by 11:04 a.m. Eastern Time, 15:04 GMT. U.S. West Texas Intermediate crude was down $7.69, or 7.3%, at $96.42. Crude trading under extreme pressure this AM as a defensive posture continues with consumer sentiment still in a depressed mode along with a COVID resurface in China, said Dennis Kissler, Senior Vice President for Trading at BOK Financial, adding that a record dollar was triggering more selling liquidation.
Next, we have the top news in metal markets.
Aluminium prices tumbled to their lowest in more than a year on Tuesday on expectations of rising supply from top producer China where smelters have been ramping up output. Benchmark aluminium on the London Metal Exchange (LME) traded down 0.4% at $2,370 a ton in official rings. Prices have earlier hit $2,352, the lowest since May 2021.
Dalian and Singapore iron ore futures dropped on Tuesday on persistent concerns about weak demand in China, with the state planner's announcement of a plan to build more roads offering little relief to flagging markets. The most traded iron ore, for September delivery, on China's Dalian Commodity Exchange dropped up to 4.7% to 709 yuan, $105.38, a ton, its lowest since July 6. It was down 3.5% at 718 yuan, as of 0330 GMT. On the Singapore Exchange, the steelmaking ingredients front-month August contract was down 2.4% at $107.40 a ton, after earlier falling to $105.80, its weakest level this year. We will now look at the top news in the agricultural sector. Euronext wheat fell further on Tuesday, pressured by a pullback in Chicago ahead of U.S. government crop forecasts and by renewed hopes that Ukraine's seaports can be reopened, traders said. September wheat on Paris-based Euronext was down 1.8% at €346, $348.25, a ton, retreating further from Monday's almost three-week peak of €371.25. Chicago wheat also fell for a second day, curbed by a 20-year high for the dollar and adjustments ahead of the U.S. Department of Agriculture's, USDA, monthly world supply and demand outlook.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.